Hello and welcome to Money&Co. I'm Martin Baker. Money&Co is a young financial services company cited in the alternative finance sector. Could also be identified somewhat trendily, perhaps not always helpfully, as a crowdfunder. I am joined by Nicola Horlick, CEO and founder of Money&Co, who's going to explain what it is that Money&Co actually does and why she's excited by the prospect of a revolution in the individual savings accounts market, driven by crowdfunders just like Money&Co. So, Nicola, welcome.
Thank you.
I suppose the first thing to do is to nail down exactly what it is that Money&Co does.
Right, so Money&Co lends money to good quality UK companies, small and medium-sized companies. And there are so many of them that are perfectly good companies that have profits and good cash flow that for some reason are unable to borrow money from the bank. And so instead of borrowing from the bank, they will come to Money&Co and we do our due diligence on them as a company and decide whether the loan is the right amount for that company, whether they can afford it. And then if we're happy with all of that, then we put the loan on our site and then it's funded by individuals. And individuals can either hold that directly in their own portfolio of loans, or they can have a managed portfolio, which we manage for them, or alternatively, they can put those loans into an ISA wrapper.
So it sounds pretty much like a credit union for the 21st century. I mean, the difference being that the lenders go onto the internet, discover the site, and they use that medium, the internet, to actually make the loans.
Yes, I mean, basically what it's doing is finding people who want a better rate of interest on their cash and connecting them with people who need to borrow money to create a bigger business.
So what's the average rate of return for a Money&Co lender?
So at the moment, across all our loans that we've ever done, the average rate of interest is about 8.7%. We then take a 1% fee, so the net yield to the investor is 7.7%. And if you put that into an ISA wrapper, then you're getting that income completely tax-free.
I'm very excited about the independent savings account aspect of all this, but we'll come to that later. You mentioned a managed portfolio service. In other words, perhaps you give us more detail on that, how much money you need and what the actual service offers.
Yes, so you need to have £100,000 to invest in loans to get the managed portfolio service account. And then we have a fund manager who basically makes decisions about which loans that will go into the portfolio based on what we've discussed with the new lender at the outset. Some people are more risk averse than others. Some people would rather have a lower yield, but what they would regard as safer loans. So they might say, for example, we have 5 loan categories currently: A plus A, B plus B, C plus, with A plus and A being the most risk averse and the safest companies. And they would yield 7% for an A plus loan and 8% for an A loan. So somebody might say, well, I'm prepared to take a lower overall yield and I only want to have A plus and A loans.
So basically, the higher the risk, the higher the yield. That's the old correlation between there's no such thing as profit without risk. Okay, perhaps you could drill down a little bit onto this idea of how you, the notion of how you assess risk, because crowdfunding, debt crowdfunding, which is essentially what Money&Co does, is familiar to some, but to many investors and their advisors, it's a brand new asset class, and they're understandably cautious about the levels of due diligence that go into a potential loan offering before you allow it up on the Money&Co side.
Right. So we have an algorithm which actually looks at the basic metrics and decides whether we should lend or not. So what happens is a company will apply online, they'll fill in a form, we have a link through to Companies House so we can then draw down the accounts, and that algorithm will make the initial decision. Now, we would never lend just on the basis of what an algorithm says, and I think personally that that's a highly dangerous thing to do. But it's actually a really useful tool because it screens out the loans that simply don't meet our criteria. So then what we've got left are the ones that do, and then an analyst will be allocated to that particular borrower and we do further analysis. And indeed, we'll actually visit the company, because doing things online, especially lending money, is potentially open to fraud. You could have somebody coming on and pretending to be from the company when they weren't, or you could have people setting up companies with fraudulent accounts and then trying to borrow money. So we want to make sure that that company really exists, that they really have the assets that they say they have, because that's what we're going to be securing our lending on. So we visit the company, and only when we've done pretty deep due diligence will we agree to lend. And at the end of the process, where the analyst has been through the whole situation, he or she will write a note. That note gets submitted to our credit committee, and then the credit committee makes the decision. But unlike a bank, where they have a credit meeting every month, we can have an ad hoc one tomorrow. If there's a note and we need a decision, we'll have a credit committee meeting and make a quick decision.
Okay, so in theory that sounds an admirable combination of speed and efficiency in actually doing some proper analysis of the companies. That's great theory. What's the practicality? How has Money&Co facilitated in terms of bringing lenders together with companies, and what bad experiences have you had? Has the loan defaulted yet?
Right. So we have lent £10 million so far. We've been lending for 3 years. So far we've had no bad debts, so we haven't had to completely write off the loan. We have had a small number of defaults. And frankly, it's impossible to lend and not have any defaults at all. The definition of a default is that somebody hasn't paid the money they're meant to pay during the month. So where that's happened, we talk to the company, find out why that's happened, work out if there's a way that we can help. And we've had one instance, for example, where a company was paying back some capital and some interest every month, got into financial difficulty, and now they're paying interest every month, and we've agreed some capital repayments to be made over the next 3 years. So the money hasn't been lost, there has technically been a default, and the lenders aren't getting exactly what they signed up for, but hopefully they won't lose any money and they will get all the money back. It's just going to be over a different time scale. So I think it's impossible to have no bad debts ever, but so far we've avoided having any bad debts, and the loans that we have lined up for the next few months all have a high degree of security, with first charges over property, where that makes it much less likely that you will lose any money. So we're trying to make sure that the loans are as secure as possible.
Let's turn now to the ISA market, which is a huge reservoir of money. And just looking at the latest HMRC statistics, the tax year to April of 2017, the ISA market was worth £585 billion, with 46% of which are in cash ISAs, and a lot of money seems to be drifting out of cash ISAs. The 62 billion subscribed in 2016 to 17. It was down by 18 billion, and a lot on the preceding year, and that's because the HMRC says it's driven mainly by an exodus from cash ISAs. Clearly, that's because the returns on cash ISAs the returns are pretty miserable, let's be fair. So I can see why, now that the loans are defined as an investable asset class for individual savings accounts, why you might be very excited about that. So perhaps you just sort of maybe expand on what I've said in terms of the state of the market, and also give us an outline of where you think Money&Co and lenders like Money&Co might be able to take advantage.
There are now 3 different types of ISA. So originally there was the stocks and shares ISA and the cash ISA. There's now a third type called the innovative finance ISA. And this was specifically introduced by the government to allow people who are doing peer-to-peer lending on sites like Money&Co to actually put their loans into an ISA wrapper and receive their interest completely tax-free. And part of the reason that the government has done this is to encourage people to lend to companies to help small businesses, because 90% of companies in this country are actually small and medium-sized companies. There aren't that many very, very large multinationals by number. So a lot of people work in the private sector for small and medium-sized businesses, and the government wants to make sure they're properly financed. Now, this also is very good news for savers because people are desperate for yield. It's very, very hard to find yield. That's one of the reasons why money is seeping out of the cash ISA market, because the yields remain incredibly low because interest rates are so low. You're lucky to get 1.5%. Most cash ISAs yield just over 1%. So it's a very low return, and now inflation has picked up to 3%, you're actually losing money in real terms. So people are now beginning to think about what else they might invest in, and before, the only choice was a stocks and shares ISA. Even there, the yields on stocks are lower because the stock market has gone up, therefore the yield has reduced. So actually, the third type of ISA, the innovative finance ISA, which has these loans, is now a very interesting alternative if you're actually looking for yield. So our loans yield 8.7% gross, net of our fee, that's 7.7. So that means that if somebody does their full ISA allowance for this year of £20,000 into an innovative finance ISA with Money&Co, they will be getting a 7.7% yield. When you take into account the caps that have now been put on pensions, this is a very, very good thing for people to be doing. And indeed, what's interesting about the HMRC statistics, if you look over time, there's been an underrepresentation in the ISA market amongst higher paid people. A lot of people haven't bothered doing their ISAs. I think now, with an ISA allowance of £20,000, meaning that a married couple can do £40,000 in a given year, and all the restrictions that have been now put on pensions, it's very important that wealthier people, higher earners, do their ISAs every year. And this is a very good thing to put them into, because then you're getting a very significant yield.
So the three major considerations, you've dealt extensively with yield, then there's access, which means what happens, how do people get rid of their loan if they want, say that they've got a child who's getting married and suddenly they want an extra £30,000. And then, of course, there's security. So if we've dealt with yield, what about access and security? I'm thinking here particularly about the financial services compensation scheme.
Right, so we are not covered by the financial services compensation scheme. So in theory, if a company goes bust, you can lose all your money. Since a lot of our loans are what are called amortising loans, where the company makes a repayment every single month, it's probably unlikely that a company would go bust the month after we gave them the loan. So it's probably unlikely that you would lose all of your money, but the point is you could lose a substantial amount.
That's just a factor that people have to be aware of.
Yeah, they have to be aware of that. Now, from a lending
you take a charge on the assets of the company, don't
yeah,
you?
we take a charge on the assets of the company, and more of our loans actually have property security as well. And if we're not happy with the security that we're getting, we will also take personal guarantees from the directors, and underlying that might also be some residential property. So we try to make it as secure as possible, but there is a risk that you will lose some money, and it is not covered by the Financial Services Compensation Scheme.
What about access?
So just to finish off on that point, the government did, though, introduce a concession for people lending on these platforms, which is that if you do lose some money during the course of the year, you can offset that loss against the income that you've received and reduce your income tax liability. So that, in effect, means that you're getting tax relief at your marginal rate for any losses that you make on the platform. So that's worth bearing in mind. So then,
access, if you want your money early?
Yes, if you want to get your money out early.
Because these are fixed-term loans, typically, aren't they?
They are.
Up to 5 years.
Tend to be, yes, up to 5 years. The average is 4 years. Most of the ones we've done recently have been 3 years. But we have a very active loan market. And when a new lender comes onto the site, they're often very keen to establish a portfolio quickly. And so they will go onto the loan market and buy pieces of loans.
And they're buying them from other lenders.
And they're buying them from other lenders.
I see.
And everything has shifted through the loan market pretty rapidly. And we charge a fee of 1/4% to the vendor. So whoever's selling will pay us 1/4% as a commission for selling through the loan market. But from the point of view of new lenders, it's actually pretty good, because then it helps them to establish a portfolio.
Okay, great. Well, I think we're getting close to wrapping this up, but let me just ask you final question really, from the point of view of the investment advisor. If I were advising a client and I'm faced with this relatively new asset class, the peer-to-peer loan, or loans that Money&Co facilitates, what kind of due diligence could and should I do? What kind of comfort can I take that you are who you say you are and that the loans are as solid as they appear to be? What's the comfort for
Right,
advisors?
so we have a due diligence pack which we can forward to any independent financial advisors who are looking at this area. We're also doing a number of roadshows, so we're going to be going around the country probably several times between now and the 5th of April. So everybody's welcome to come to one of our roadshows. We'll also be supplementing that with some sandwich lunches in London. If anybody's down in London or they're based in London, they can come to those. And we're very happy to visit firms of IFAs. You know, if you've got several partners, it's actually very efficient for us to come round to your offices and actually tell you about the innovative finance ISA. I think this is something that people are going to start asking questions about, because it's only very recently that all of the platforms have received their full FCA approval, and they were only allowed to offer the ISA after they'd received their full approval. So now I would expect there to be quite a lot of coverage in the newspapers about the innovative finance ISA, quite a lot of advertising is likely to occur, and so I think clients will start asking advisors about the innovative finance ISA. So I think it's something that people need to get up to speed on.
So essentially the marketing drive of this subsector of the industry is going to drive this thing into the mainstream. The way that, say, emerging markets were a novelty 30 years ago and 10 or 15 years ago, even private equity wasn't seen
but I think
as a novel
the main
asset.
thing that's going to drive it into the mainstream is that a lot of people want yield, and it's very hard to find it. And if inflation's 3%, a return of 7.7 after fees is pretty good. You're getting a real yield of 4.7%, and I think that's very attractive.
Well, that has to be worth a look, so I think we'll leave it there. Nicola, thank you very much, and I hope you've enjoyed this initial webcast by Money&Co. There'll be more coming, both audio, visual and audio in the future. Thanks and goodbye.